Welcome everyone. So thank you for coming to today's webinar. We have Carl Fisher here from Camaplan, and we're going to be talking about how to make tax-free income for life and how to buy real estate in your IRAs and your 401ks. So Carl Fisher is a Cornell University graduate. He began his investing career in the 70s and was employed as a rocket scientist. I'd love to hear more about that maybe another time. It's very interesting. He's one of the founders and principals of Camaplan, which was founded in 2004. And he's implemented plans and managed millions of dollars in real estate transactions. So let's give Carl a warm welcome. Thank you so much. As you can hear, Anish and Carl have a lot of rapport. They know each other very well, and they definitely get together on those National RIA cruises. So
yeah. I wouldn't say very well. I'd say well, not he's got some
okay, well enough. Next National RIA cruise, you'll say very well though.
Yeah, I don't know. We may go fishing here in a few days.
Yeah, I'm down with that.
Yeah.
It's hopefully the weather's on your side. It's been quite rainy in South Florida for the last couple of days.
I know.
Well, upcoming events, we have the money is in the follow-up with the CEO of RIAFax. We'll talk a little bit more about Francisco Mago. His event is going to be on the 30th at 11 a.m. We also have how to increase returns and decrease risk for your real estate investments, Tuesday, October 5th at 11 a.m. This is by Mike Fernicola from Unbridled Wealth. Some of you guys may have attended his webinar, I believe in May or June. So he'll be back presenting with one of his business partners. And then we have our monthly meeting on Wednesday, October 6th at 7 p.m. And Anish will be running that one. It's going to be all about the BRRRR method, and we're going to put a spin and a twist on it, and we're going to be talking about short-term rentals with the BRRRR method. And we have our biggest event of the years. Our biggest events are going to be our boot camp. So that's where you're going to get that time, that intensive time with our lead mentors. We have our special guest. Like I said, Francisco from RIAFax will be there. We have Jose Ramirez. He's often on our webinars talking about tax plans. He's our go-to tax advisor in the South Florida area. All of our mentor students see Jose. We have Carl Sheely, lead contractor, our go-to contractor here, and Kevin Thatcher of Independence Title. It's a great event if you are trying to learn more about real estate investing in South Florida. If you are newer, if you're wanting to grow your business, if you want to get your questions answered, it's a live event. Your mics and cameras are going to be on, unlike these webinars, so you have that face-to-face interaction with the pros in the South Florida area. It's an offer that can't be beat. So we have in the chat right now, you're going to see a link to the bootcamp page. It's this weekend, so it's probably going to be the last one of the year, and definitely take advantage of it. If you're on the fence, it's worth it. Trust me. Alrighty, and then next up, we are also home to our mentor program. If you want that one-on-one attention, a lot of the times people take the information that they learn in the boot camp and are able to make their first deals. If you need that one-on-one guidance, we have our mentor program. Alexa is also going to put a poll up. If you'd like to talk a little bit more about our mentor program, go ahead and answer that poll. You can have a one-on-one consultation with Anish where he goes in the ins and outs. He talks about your goals, where you're at, and see if the mentor program is a great fit for you. So if you want to have that consultation, set it up, maybe get some more information and details, answer that poll, and we'll get connected with you later, probably this week. And then next up, we just wanted to let you know that today's event, there is a giveaway for all attendees. So just for attending this event, Carl was generous enough to give away his ebook with Camaplan, 20 Ways to Fund a Deal. If you'd like to get access to this ebook, definitely check out the thank you email that you're going to get after this event. So stay tuned for that. They'll probably come in around 1 o'clock. So stay tuned if you want to get that ebook, and you probably will, especially after you hear Carl's presentation. We have our member benefits as well. We offer with National RIA deals and discounts to so many places, so many vendors, national vendors. If you want to learn more about that, we have some videos on our YouTube channel all about our membership, and you can definitely contact our office if you want to learn more information about that. It's definitely helpful if you are a real estate investor. Helps you save money. Saving money helps you make more money, right? All right, and just thank you to our sponsors. We couldn't be here without you guys, and that is about it for me. And without further ado, I would like to present to you officially Carl. So Alexa or Anish, if you don't have anything else, I think it's time for Carl.
Absolutely. So
Right,
Carl, if you want to go ahead and share your screen, it's all yours. You're driving this.
Do this
Okay.
thing.
We good?
We're good.
Can you see it?
Yep, we're good.
All right. Hey, the first thing I want to do is thank you for inviting me today. I always like to talk to South Florida groups, and both Alexas have been great, and Anish, I really appreciate it. I also want to say you guys have a lot of good things coming up here in the next few months. And one of the things that I've found is people that avail themselves of these people and these groups basically build their network a lot faster. And in my thought process and things I've learned is your net worth is equal to your network. So think about that if anybody's questioning whether or not to attend. I love it just for figuring out who's who and building on good people that are already there that I can include into my network, because I like to build those relationships before I need them anyway. But so from that, where I digressed a little bit, let's get into tax-free income for life. Who would like to see those types of things?
I would definitely.
Righty,
Yeah, I don't want to
me,
pay taxes, right?
Yeah, no, I'm with you.
I legally don't want to pay taxes. Let me rephrase that.
Yeah, I'm running into a little bit of a problem. There we go. But I went backwards now, right? There, all right. Now we're working. So this is just my disclosure. You know, I always want you to bring in your trusted advisors, your mentors, the people in your group, the people that are close to your financial advisors. We encourage that before you do any type of investments. What I'm going to show you today is educational. I don't think anybody's ever taught you this type of stuff in school. I think most of the time they teach you in school not how to be wealthy, but how to get a job. Let me just, I've got to move one thing here out of my way, right? So tax-free income, that's the main subject for today. And I'm going to talk specifically on self-directed IRAs and 401ks and other plans, what they are, where and why. And the other thing is, a lot of people on here can do more business if they have or raise money. And a lot of the people that work with us raise either a little bit of money with individual private lending and notes, or they do a syndication and raise millions of dollars. And then we'll touch on the attack on Roth accounts. The people up in Washington, D.C. think that they're too good to have wealthy people have them. And when they, just a little history on that, when they opened up Roth accounts, they did not allow anybody that made over $100,000 to basically contribute to one. And that was back in 1998. In 2010, they said, all right, nobody's really using these Roth accounts. Let's open them up to everyone. And at that point, a lot of the wealthy people jumped on the bandwagon. And we'll give you some time at the end to ask questions, but Anish and I talked about that in the beginning. And if the question is pertinent to the slide that we're on and it's not too specific, we will hit it right then so that we don't forget it going on. I don't know what I did. I think I hit the question box there, and this you'll have to fix that again, I think.
Yep, no problem. We'll take care of that.
There we go. Alexa did a nice job in my introduction. I'll just go over a few other things here. I grew up in Fort Lauderdale, Florida. My mom and dad moved here when I was 2 years old. I thought it was great. It's changed a lot in the past 65 years. Camaplan was started in 2004. I did real estate investing basically my whole life. My mom and dad were in it, and their moms and dads were in it. So guess what? I'm biased towards real estate. All of my brothers and sisters are in real estate, and my kids are doing real estate, either as their job or on the side. I own rental property, both commercial and residential. I got burned out on paying taxes when I found out about people that weren't. And what I did is I looked at how they did that and followed it and learned from them. That I used them as a template or as a pathfinder for me. I don't mind coming in second if I can follow somebody on a winning strategy. It's okay. I don't think there's anything wrong with that. I don't think it's cheating. I think it's taking the time and learning, and maybe I'm a visual learner. I'm not sure. As we talked a little bit earlier, I've been married for 41 years. I've got four boys and I got 6 grandkids, and I like to spend more time with my grandkids than I do with my own kids at this point. So I think we do that. So I think right now, and you'll see it come out when I talk, is I'm biased towards tax-free versus tax-deferred. And my favorite investments are real estate because I've been in it, I know it, and I understand it. So you can do a lot of other things, and I recommend that people invest in what they know and understand. That's probably the most important thing. Don't invest in things you don't know and you don't understand, because that's where the risk comes in. Everybody tells me, or a lot of people tell me that real estate is risky. And I say, compared to what? The stock market? And they say, yeah. I said, well, then you probably know the stock market better than you know real estate. And I'll tell you, I don't know the stock market very well at all. And I bought software and tried to learn it, but there's just too many variables that I can't control. So I'm much more comfortable in real estate. But throughout the presentation, don't let that jade you, even though I'll go back to what I'm familiar with. You can do self-direction with any assets that you think are what you want to do, that you know and understand. So what is it that we look at? I mean, reducing taxes is one way of doing this. Growing wealth is another reason people use self-directed IRA. People looking for money are going towards self-directed IRAs because most people have 7 times more money in their IRAs, 401ks than they have in their bank accounts. So if you're looking for money, go and take a look at the self-directed worlds, talk to people about their IRAs. Think about it today. You can't get a CD over 2%, and most of them are under 1% if they're short term. So borrowing money is relatively inexpensive. But when you're looking for money, you can do individual loans. If you're getting ready to flip a house, you can borrow 50 or 60,000, whatever you need for the rehab. And then other people are buying multifamily offices or self-storage areas. And you can get in a syndication where you put your money into the syndication, and then you have a percentage, a pro rata share of that bigger asset, be it a 700 unit apartment complex, or square footage and self-storage, or any other indication. So just think about where you want to be, and then figure out, because in real estate, there's a lot of ways that you can make money, right? There's buy and holds, there's flips, there's multifamily rentals where other people will be doing the management and the purchasing, and you just take a ride along, or your money takes a ride along. So what I want you to think about is making your money work as hard as you do. I can't stand lazy money. Making 1% in a CD or 0.1% in your checking account. There's so many better ways to take that money and invest it. And you can almost invest in anything that's out there. So this moves me to, I want to teach people things that they don't teach me in school. And like you saw, I went to an Ivy League college, and it took me till I was almost 40 years old to figure this out. I had an inkling of it when I got a job, and they were telling me I was making, $10 an hour. And then when I took home my check, was, 20% less. And that was, when I was 18 years old. And I looked at it, I said, I thought I was making $10 an hour. And my boss said, yeah, but you have to pay Social Security and Medicare and taxes. I said, well, that's not very good. So I got an inclination right then, but even in college, nobody talked about it. They actually, on some of the tests, said disregard taxes. So I want you to really take this. If you need to, take notes. If you make $100,000, and these are just rough estimates, at your job, or as your W-2 or your 1099 if you're a contractor, you're going to end up with about 60,000, right? Why are you going to do that? Well, because the federal government's going to take some from you. The people in Florida, you don't have a state tax, but California's got a state tax of 10%. My office is in Philadelphia, and some of my income I have to pay the Philadelphia state tax of 3+%. And then also there's some towns and locales, same thing in Pennsylvania, in the town I live in, and right outside of Philadelphia, I've got to pay a 1.5% tax. And then the Social Security and Medicare, where I am both the owner of the company as well as the employee of the company, I end up paying 15.3% total there. So you can see quickly how those tax rates can get up to 40%, depending on how much you make and what categories you're in. So I believe that you should use your W-2 for whatever you're making, but don't spend a lot of time on that. Okay. The second one is passive income. And basically you still have the federal, state, and local, but with passive income, such as rents or royalties or interest on a loan or dividends in a syndication or capital gains on a long-term capital gains when you sell it, you're going to pick up at least 15% because you're not paying the Social Security and Medicare on what they call passive income. Now, I am going to tell you that real estate, even though the IRS calls it passive, when you're involved in it, it's not passive. You still got to talk to the tenants, deal with the toilets and the trash and all the other things that are there. But I also think that you make, 15, right now I make on my properties between 12 and 20%. I've had, I'm a buy and hold investor, and I've had them for a long time. So to me, getting 1% in a CD or getting 15-20% on a piece of real estate, it seems like it's a no-brainer. And hopefully I have a chart further on in here that'll talk about that. So out of that 100,000 in the passive environment, you get to keep 75,000. Now you go to a tax deferred account, such as a traditional IRA or a traditional 401k, and you don't get taxed on any of that, right? As you're making money, all that money gets to go back into the account. You get to reinvest that money without paying taxes. You know, some people pay taxes on their interest. Other people make interest on their taxes in these tax deferred accounts. The only problem with the tax deferred account is when you get older, or when you start taking these distributions, you have to pay the federal, state, and local tax at that point in time. So it's kind of, you're giving me this ahead of time to work with it for a certain amount of years. But by the time you turn 72, the government forces you to start taking that money out, whether you need it or not.
Yeah.
My favorite.
Carl, I was just going to actually touch on that too, since I know, you know, us owning the RIA, and I know you have a lot of investors or, you know, in your network, is that, you know, most people think, hey, at 72 or 72, I'm going to make less money. I can't tell you how many people are making more money and they're forced to take out that RMD, that required minimum deposit. So imagine you're still making $300,000 or $400,000 on your properties, or I don't know, you're still working, you're doing all those things, and now you're forced to take out $40,000 or $50,000, and depending on what your tax bracket is, you know, you might lose 30 or 40%. So, you know, I know the basic thinking is like, hey, I'd rather not pay taxes now, I'll pay it later, and then when later comes, and if you're still doing well, it's going to actually cost you more in the long run.
Right. And well, and the other thing that's a great point, Anish. And some people say, hey, I don't need this money. I'm good. I've got my Social Security. I've got my rental properties. I don't need it. Let me pass it down to my grandkids. Well, you don't. You have to start taking that money out. You can't pass your IRA on to your kids or your grandkids, you know, and build a legacy while you're still alive. So I just think that if you're going to go to this point, take that extra step, pay the taxes now, and get into a tax-free Roth. Because on the tax deferred accounts, everybody does that because, you know, when you go to see your accountant, he says, hey, if you put 7,000 in, I'm going to be able to get you $3,000 back in taxes based on your tax return. So they go, oh, okay, I'll do that, and I'll put, you know, 7,000 in and basically get 3,000, and you have an account that says 7, plus you got 3,000 in your hand. So it's you know, a really good deal, people think of. But now,
yeah, I was going to say, on top of that, how many people, because we meet so many people, our members online, go ahead and put in chat, are you guys looking to build generational wealth? Right? Give me a quick yes or no. What you're going to realize if you're not doing this now, it's good. You're not building it. You're giving it to the government. So look, I got a bunch of yeses.
Yeah, no, I mean, if you think about this tax-free Roth, right, you're paying the taxes on that $7,000. But then if you turn that into 70,000 or 700,000 and you go to pull it out and you're paying 40%, you're going to be paying, you know, $300,000 in taxes, whereas you could have just paid 3,000 today. And now that 300,000 is if you pull that money out in the future. And if you make it into 7 million, you know, it's even more taxes. So let that Roth build. It's worth more to you. You don't have to take RMDs as it is right now. They did make a change at the end of 2019. You used to be able to pass this on for almost a decade, you know, what they called the stretch IRA, but they've changed all the IRAs now to where 10 years after you die, it has to be distributed. But even still, the Roth, when it's distributed, will come out tax-free to your heirs. And who knows what the taxes are going to be in the future. But I will tell you this, when John Kennedy was killed and president, it was 90% when he took the presidency, and he reduced it down to 70 72%. So that's the highest I've seen it in my lifetime. And Ronald Reagan got it down to 28%, which has been the lowest. Okay, and today the highest bracket is 40%. So we're still way below the 90 and the 72. So when I look at that, I question, you know, where our tax is going to go, and the way they're spending now, you can see that they're going to go up in my estimation. And I don't think it's going to be very long. And no matter, you know, even if you tax all of the wealthy people, you're not going to get what they're spending. So it's going to have to keep coming down to, you know, until everybody's paying something or more than they are today. So the point is, these are the 4 types of money. You know, I want you to make what you need to eat on. I don't know. Some people can get away with 50,000. Some can get away with 100, some 150, whatever that is. Make that in either W-2 or passive accounts, preferably the passive account because it gets there faster. But do everything else in your Roth IRA, right? Make only what you need and put the rest into your Roth IRA. If you're going to buy, you know, 5 houses, why make $1 million this year and pay, you know, 400,000 in taxes? You know, make 150 in your account, or 200,000 buying your houses, but then do the other houses or the 800,000 in your Roth IRA, because you're not going to get taxed on that, and you'll have 800,000 at the end of the year. You will have paid your taxes on the 200 and spent that money, but now you've got an $800,000 account that's building and growing even more. So this is stuff they don't teach you in school, but you have to go and look at this and figure it out and put it on your radar. When you're thinking about trying to get a raise, don't think about the raise. It's more important to think about investing your Roth money, because that's going to make you a lot wealthier than any raise. Every time you make a raise in your W-2 or your 1099 job, the government takes more money. So every time you know, and they don't help you get that raise. You know, I don't think Joe Biden stood behind anybody and said, hey, let me help you get this raise. But sure enough, they get their money right then. Neither is the governor, right? DeSantis hasn't stood behind you and said that. But guess what? He doesn't even take it, right? In Florida, we're one of the states that don't have a state tax. So think about those things, right? Social Security and Medicare, they take their money right away from your raise as well. But when you're making money in your tax-free Roth, nobody takes that money. Okay, that's all yours. You can build your wealth so much faster when you're not paying taxes on it. Does that make sense?
Makes sense.
All righty. What's an individual's largest expense? It's taxes. Okay. And you can look down here and you can see all the different types of taxes you get hit with. These are what I call, you know, I'll ask people, have you ever been stepped on by an elephant? And they go, no. Have you ever been, you know, bitten by a lion? No. Have you ever been bitten by a mosquito? Oh yeah, for sure. Well, this is what they do with taxes. It's the little things, and none of them are really worth fighting one at a time because they're so little. But when they put all of these together, it's a big bite out of your living expenses, etc. And just sit down and go through these individually, and you can see what that does to your lifestyle. People ask me, well, who do you work for? Well, I work for the school board because I pay those taxes. I work for the state because I pay my real estate taxes. You know, I work for the hospitals because I pay my Medicare. So, you know, you're working for all these different taxing authorities because it takes some of that money from you. Again, I was never taught this in colleges. But It's not how much you make, but what you get to keep. And we already talked about the Roth IRA lets you keep the most. So think about those things when you're trying to come up with your wealth plan, right? And in the news today, everybody's talk about tax avoidance strategies. Well, there's the marital deduction, and I'm going to tell you, I've been married 41 years, and it's not worth the marital deduction to get married. You know, that's just something that's you know, a benefit if you do get married. And you get a kid's deduction, and the kid's deduction is way more than it's ever been when my kids were little, but it's still way less than what you're really going to spend. So don't have kids for the deduction. It's not worth it. You know, the long term is, I do think it's worth it. I think it's fun, and you know, it's one of my greatest accomplishment is my kids and grandkids. And I kind of lucked into that. Home mortgage interest deduction, they're talking about getting rid of that. Business expense deductions, those are I think are good. Depreciation and bifurcation, 1031 exchanges, they're on the chopping block as well. There's ways to use life insurance to avoid taxes, but we're specifically talking about tax-free and tax-deferred plans today. But you need to understand these things to cut your taxes and build your wealth faster. I'm hoping that makes sense to people, right? So why does self-direction work for investors? Well, let's take it from myself, right? You can get tax-free income for life. I just told you that with the Roth IRA. I like tangible assets, right? I can see a piece of real estate. I can touch it. I can insure it. I can finance it, right? I'm familiar with it. You know, I have access to the managers, right? It's either my management company or the property management company that I have. I can drive by the property. I can see what condition it's in. I can see if the tenants are maintaining it or if they moved out. So I have more control, right? I think it's less expensive because I'm not always paying different fees associated with other investment types. Not that you don't have some fees like taxes and maintenance, et cetera. And the other reason is it's the only way you can get real diversity, right? If you go to financial planners out there at Schwab and Merrill Lynch and Fidelity and Vanguard, you're only gonna be able to buy what they sell, and they all buy and sell the same thing: stocks and bonds, CDs, basically. So if you can go out and get real diversity using these things, people like it, and you get to use that diversity in things you understand. How long have you been working in real estate, Anish?
I've been in it for about 20 years. I
Okay,
actually
so
had hair at one point, and then I got tired of working, and then I had to pull it out. But yeah, it's been about 20 years.
Yeah.
And
So-
actually, what I wanted to actually touch on one thing that you brought up, which is important. Before, you know, I learned the self-directed world actually from you, because you're one of my mentors. You know, I had an account with my broker, and the thought of actually putting money in retirement towards real estate or other things, like you were talking about, you know, a Vanguard fund, like I thought that's all you could do, some mutual fund, and I just had no knowledge. And this is a college buddy of mine, and you know, I didn't even hear of such a thing as a self-directed IRA. I mean, do you want to kind of actually just touch on, as you know, as an intermediary or as what you do at Camel Plan or these companies, like you don't actually give any advice on
no,
what to buy?
give me a couple more slides and we'll get there.
Okay, you'll get to it. Okay, perfect.
All righty. Let's just talk about how it works, right? You're going to open up a self-directed account, IRA, just like you would at Vanguard. It doesn't look any different except it says self-directed on it. And then you're going to fund the account. You're going to put funds in it. How do you do that? You can transfer it from a IRA that you have, all or some of it. You can roll it over from an old 401k, or you can make a contribution to it just like you do each year to any of the other accounts, right? Then you're going to choose your investment. Once you have your money in there, you're going to find an investment, whether that be real estate, a note, or private placement, or gold or silver. But whatever investment you find, piece of real estate, a single family home, in Fort Lauderdale, you're going to go and look at that paperwork, write a contract. Once you have the contract the way you want it, CamaPlan's going to sign it, and the title company is going to do the work, and we're going to send the funds that you put into your account to buy that. So instead of it being in your name personally or in your LLC, it's going to say CamaPlan for the benefit of your name, IRA. And then if it's a rental property, you're going to go online on our account. You're going to see your rent come in every month. You'll see a payment go out. If there's a hot water heater that needs to be replaced, you'll hire the plumber that'll put it in, and you'll have the IRA pay it. So it's pretty much that simple. You get to do it, but the IRA owns it. If you look at the deed online, it says CamaPlan for the benefit of your IRA, either your account number and or your name. And that's basically all there is. And the money comes in tax-free. So where you're depreciating and taking the all the benefits you can when you don't have money in your IRA, you don't have to worry about that because all the money's already tax-free. And it makes your accounting and your tax forms a lot easier to do at the end of the year. This is for people that have syndications or want syndications. I'm not going to talk about that right now, and mainly because there's a lot of legislation put here when people try to use self-directed IRAs to buy multifamily investments. It's being rewritten right now in Congress. They're trying to take this option away from the wealthy people. So maybe next time we'll talk about it, because I don't know where this legislation is going to end up. So what is a self-directed IRA? That's the first question, right? And this is a great definition of it here, on the screen. But to keep it simple, it's an IRA that you can invest in anything you want. And I have an asterisk there because there's a couple things the IRS says you can invest in, and that's life insurance and collectibles primarily. So right, what's the difference between CamaPlan's self-directed IRA and Vanguard's or Schwab's? And I'll talk about this in the next two slides. All the rules are the same, right? The statements at Schwab, Fidelity, Vanguard are primarily showing you stocks, CDs, and mutual funds, even if you're even looking at them. Most of our people invest in real estate, notes and mortgages, tax liens, or private place, private stocks, private investments, right? A lot like Peter Thiel and Mitt Romney had done, that have been in the news lately, right? Transfers, rollover, contributions, distributions, all those rules are exactly the same. So you can take money out of your account, depending on what type of account it is. You can roll it over to another one. The amount of contributions you give are all the same. There's no taxes or penalties to move your account from a Schwab or a Fidelity or a Vanguard to CamaPlan. It's like moving it from one IRA custodian to another. So think about that. Some people say, well, I'm not sure about this, but I'd like to give it a try. If you bring it over and you try it, you can bring over as much or as little as you want. You can try it out. If you don't like it at the end of it, you can transfer it back. You can have as many transfers in a year as you want. So all of that is pretty much the same. This is kind of shows you the CAMA statement and the Fidelity statement, basically Freedom Fund, Growth Fund, and over here you have cash, real estate, and secured notes on the CamaPlan, which is, the ballpark I play in, right? So what does CamaPlan do? This is what you're getting at, Anish. The IRS requires you to use a third party to open a self-directed IRA. any IRA, right? You have to go to Schwab, a bank, or Vanguard, or somebody to do that. We're a neutral third party, right? We don't give any investment advice, and we don't have any products to sell, right? We specialize in the legal IRS approved use of tax-free and tax-deferred retirement and savings plans, right? Vanguard and Fidelity can do these types of investments, right? But they choose not to. I mean, look at the paperwork that you have to do to go through a closing and add a loan. Think about your IRA taking out a loan to close on a piece of property versus a stockbroker picking up the phone and buy 6 shares of Apple or Tesla or whatever, right? That's so much easier and so much faster. This is a little bit more work, but you're in an environment and a venue that you like. Fidelity, Vanguard, when they call their self-direction, it's only in what they sell, right? Camaplan doesn't sell any assets, so we don't care. You buy it, They're recommending that you can, all they're doing is saying you can do anything you want that we can sell. So you can buy any individual stock. You don't have to buy the funds. Camaplan says buy anything that you want, whether it's a house, an apartment building, raw land, a note on a house, any types of things. And we'll get to those here in a minute. So Camaplan does alternative investments. We're not a financial advisor. We're not a life insurance advisor. We don't come up with risk. We don't do the coaching. All we do is provide you the capability to have alternative investments. What does that do for you? It gives you more diversity and it allows you to invest in things you know and understand, which I think is very, very important. Does that pretty much answer your question, Anish, or did I miss anything?
Yeah, no, you got it right there. Do you want to actually, I know you didn't really talk about it, but a quick end of it, since we're talking about the other companies, maybe you'll get to it later, like the fees. Like I know one of the things, like how many of you guys, if you have a retirement account with any other company, right, do you know what your fees are? So when I looked at mine, I was like, oh, and it didn't matter if the market went up or down, and like as a percentage of whatever I had. And what you're going to start realizing, it's going to really mess with your compounding interest down the road versus I know you have at Camaplan more of a flat fee structure.
Yeah, the fee. The
So,
fees are basically inconsequential with us, I think, compared to what the other people charge. They're charging you most of the time between 1% and 2% of whatever you have, whether they're making money or losing money.
exactly.
We give you a flat fee. If you have $1 million, it's a low percentage. If you have 5,000, it's probably a high percentage. But we also try to tailor that. We have a couple different ways to go through the fees. All our fees are on 1.5 sheets of paper. You can see them. They're pretty cut and dry. There's no funny business. We're very transparent. My sister and I started the company ourselves because we are investors and we set it up for investors. And we said, well, how would we like it to work? And that's just specifically how we did. And all our fees are on one sheet and it's on the application so that you see exactly what it is and where it is. And most of the people say, well, how do you make any money with these type of fees? And I just say, it's a low margin, but we have thousands and thousands of clients. So people are hearing the word. And one of the main reasons is if you look at this chart right here, if you make the same exact investments, right, and you take 20 minutes and fill out an IRA form, and one person does these investments in their IRA and one does them outside their IRA, at the end of 40 years, based on, and this was 16,000 that was in there, we assumed a 10% rate of return. And I know some people are going to say 10% is a lot. Other people I know will say it's I make 20%. So you can fill in the chart and put your numbers in here and do this for exactly what you want. But in almost every single case, you're going to see that the tax-free Roth produces much more than the taxable account. So in this case, the same exact investments after 40 years, you have one worth 300,000, the other is worth a little over $1 million. If you took all that million out in the Roth, you'd have that million. If it was even in a tax deferred account like we talked about, and today's rates, you took off 40%, you'd still end up with 600,000, which would still be better than the 300,000 that's in that account. So you don't have to believe me on this chart. Just ask your financial advisor. Go run these numbers yourself. Look it up on Google. But this is the type of returns you're going to see, and the fact that you can do whatever investments you want inside or outside of the Roth IRA. You can even run this experiment for a few years and see how it works for you. I mean, I did that and it didn't take me long to figure it out. So I just want people to see this. This is a chart that most financial advisors will show you there. And a lot of people have been saying, hey, it's not worth it to do the Roth back in the years because it's, always defer the taxes. Don't pay them up front. I wanted to take that variable out of the equation. I don't want to worry about what the tax rates are now. I mean, they're ready to go back up again here shortly. And, the stuff in my Roth is protected from that. And at my age, I don't want to be worried about, thinking about that and taking steps to get out of that. I did that years ago. Right. So let's talk about, if anybody's on the fence, let's just talk about this relatively quickly. What do you think these people are going to say with everything that I'm telling? Here's what they're going to say, right? It's not legal. Well, I'm going to guarantee you that it's legal, and you're seeing everything in the newspapers and Congress and the reconciliation. So you don't have to worry about that anymore. Nobody's going to say that, but we started this 20 years ago, and that was a lot of the stuff that we talked about. Then they're going to say it's too risky. Well, self-direction is not risky at all. In my opinion, the risk comes when you invest in whatever asset you're investing. What is real estate risky? Yes, it is. Is a note and a mortgage risky? Yes, it is. Is precious metals risky? Yes, the price can go up or down. Is the stock market risky? Yes, it is. So you have to make that decision. What do you think is too risky? Putting your money in with us, it's going in an FDIC insured account or a government-backed account. So the cash is sitting there. When you put it into an investment, like Enron or WorldCom or Eastern Airlines, that was all very risky. So the other one is it complex? If it is complex, we're there to hold your hand and help you through the process. I don't think it's that complex, but again, I've been in this business, for 25, 30 years. So I'm very used to it. But once you get into it, unless you've upped your account, what do you think?
I think, first of all, same thing, people are, oh, it's very complex, or I don't have that much money. That was really my conversation. What am I going to do if I put $6,000 in? I can't buy real estate or all those other things. And then, luckily I met Carl about 7 years ago on the cruise, and, he's probably the only person or speaker I know that is also a rocket scientist. So I know, oh, hey, Carl, you're so smart. What are you, a rocket scientist? You could actually say, yes, I am, by the way. So I said, you know what, let me listen to this guy. My broker is one of my college friends, and he did get me to start a Roth, but I wasn't contributing much because I didn't really see the growth in it. I was like, I don't know, I make more money on a flip or real estate, and I didn't know I could buy real estate or notes or land, all the other stuff. And so in the 7 years since I've met Carl, I've actually my Roth IRA has gone up tenfold. So in 7 years, My wife has gone up about fourfold. So now I'm trying to buy everything I can on a Roth. If you guys have been watching some of our webinars, Ryan and I a while back showed you a house that we both bought in our Roth IRAs for $82,000, 42,000 each, and we sold the house for almost 200,000. So we made over 50,000 each on our Roth IRA, and it was tax free. So now I'm pretty excited, and my goal is actually to buy a building in my Roth for the cash flow. So am I mad that I didn't do this earlier? Absolutely. It's not too late. I know we have some younger people also. I don't care if you put, $100 a month towards it. Just start doing it. And the proof's in the pudding, right? Like, it didn't feel like it was moving fast. And then all of a sudden, I hate to say, you open up your account and you're like, oh, now I got something I could really do something with. So I mean, it's crazy not to. And I know a lot of smart people that are very good at their businesses, and they have no idea about any of this. It's not legal. Why are you doing that? Is it safe? All the above.
Yeah, but the complexity of it, you figured it out, right? And we helped you through it. So I don't think it's too complex from that aspect.
Yeah, I'm just gonna add to that. Like, I'm not the smartest guy in the world. So if I could figure it out, you could figure it out with their help, actually. So
gotcha. So these are the types of things you can invest in, right? I'm not going to spend a lot of time on. I think we covered a lot of them going through there. These are the different types of real estate. And this you were talking about over in Dubai, and I heard you were looking for a property over there. So you could use your IRA to buy one there in Dubai. And I hear they're inexpensive. I'm only kidding.
Sure. I need a little loan. If you want to partner with me, I'm down.
There you go. So all these types of things, notes and mortgages were done there. People like mortgages, promissory notes, trust deeds, all the different types of loans and notes that are out there. Why do people like them? Because they're real estate backed, tangible assets, some of the things we talked about earlier. Your known results. You're just like the bank. Hey, I'm going to lend this money at 8, 10, 12%, whatever it is, right? You're in control of the loan. You see it. You are the bank. And you got to do it right and be ethical and make sure that people, I don't like to lend money to people that can't pay it back for several reasons. It's not good for them and it's not good for me. So we try to make sure people are going to get through it, the whole way, right? You can build a new note if you're selling a property. I had a property in my IRA. I sold the property and I took back the mortgage on it. So I'm still getting paid some interest on that, right? You can have senior or junior liens, performing or non-performing notes. Some people bought non-performing notes, at a big discount and got them before performing when the market came back. Amortizing interest only, secured or unsecured. I don't recommend unsecured loans. Basically you're like a credit card company, but some people do it with close friends and trusted financial people. And you can do it on commercial, residential, etc. These are some other things that you can invest in. And if you don't see what you want to invest in, just call us up and most likely you can invest in those types of things. So how much money's in IRAs? And think about this: if you were a realtor and you could get everybody that had IRAs to buy property from you, what do you think the commission on $35 trillion would be? Be pretty nice, right? So
it'd be a lot.
Yeah. So there's a lot of money out there, and probably 35 of that 35 trillion, 5 billion of it is Peter Thiel's, right? All right, so let's talk about the different plans that can be self-directed, right? You can do the Roth IRA and the traditional IRA. You can do the business IRAs, which is the SEP or the simple, and you can have both a business and a personal one. And you can do accounts for your spouse or your kids if they're making money. You can do 401ks. They can be self-directed. There are other defined contribution plans as well as defined benefit plans. Other ones, the health savings accounts and the educational savings accounts for the kids under 18. You can do that for. The health savings accounts are one of the best things I've seen because the money goes in to the health savings account and it's deductible, right? Remember, in the Roth IRA, you have to pay taxes on it. With the health savings account, you don't have to pay the taxes on it, and you get to take it right back out for medical expenses that year, or in the future, you can just keep it in there and save it and build on it. So all of these accounts can be self-directed. And when we talk about IRAs, it's just a combination for all of these. So no matter what you have, you can most likely get it in a self-directed environment or some of it. 20 ways your IRA can invest. This is one of the things we're talking about giving you the ebook on. One of the things that I'm bringing this slide up for is, Anish, you were talking about, well, what can I do with $6,000? Well, I'll give you an example of one of the things I've seen, right? There was a house for sale. I think it was $150,000. It needed about $50,000 in rehab, and it was going to be worth $300,000. So what happened is a Roth IRA went out and it put $1,000 down, signed the contract for $1,000. And then what they did is they went out and they sold half of that contract for the full $200,000. And now the guy that was buying it for the $200,000 says, well, I'm putting all my money in. And he says, yeah, but you're going to have $50,000 here in about 10 months after we finish the rehab and sell it. And hopefully we'll do it faster than that. And he said, so you're making $50,000 on your 200,000. That's a 25% return. And the guy says, okay, I can't get that anywhere else. So the deal went through, and at the end, he got his original 200 back. They split $100,000. So that IRA that put $1,000 down and bought that contract made $50,000, as well as the guy that bought half of that contract for the 200,000. So that's just one of the ways that your IRA can do this. There's a lot of other partnering deals. There's also IRAs can borrow money. And like we said in the beginning, there are rules and regulations that you have to follow, but there's a lot of good stuff that that can be made by using these IRAs and using your head. Now you have to put the time in, and you have to think, and you have to go to meetings like you do, like you're putting on at BRIA, and you got to talk to other people that have already done this and worked the template out. But you're going to see a bunch of these people in the news, just because everybody is bad mouthing these people that took these IRAs and made a lot of money on. Right.
Yeah, I just want to go. I just want to make sure that everyone got that. So, the person, right? Alexa Marie put $1,000, but she's a deal architect. She knows how to find deals. She goes to Daddy Warbucks, Carl Fisher, for the $200,000. Carl says, cool, I'll do it. They make $100,000 in 10 months, right after it's rehabbed. And now Carl's happy with his 25% return for the $50,000 just for lending the money. And now Alexa Marie has $1,000 that she initially put plus her $50,000 in profit. And if it's in her Roth, she just made that tax-free. So her Roth went from 1,000, her next deal, now she's at 51,000. And that's how part of the way I built my IRA tenfold quickly. So there's a lot of cool things out there. I know some of you guys have kids. Guess what? You could actually partner with, Carl was talking about. You could partner with your kids on their Roth IRA. So if Alexa had a kid, and you put 500 in, your daughter or son puts 500 in, now you split that. So it's a great way to really build your wealth. So don't be worried like, hey, I only have so much money in there, but this is the fastest way you can build it, especially if you're real estate investors and you know what you're doing.
Yep. So there's a lot of people that are doing that. This is what you can do with a little bit of money, and obviously you can do more with more money. And again, remember how we said get your net worth is your net worth. So if you can get with some deal architects, that's good, right? Remember in our example, we talked about a 10% return. Here in this example, you got a 25% return. And obviously, you know, Alexis Marie in that example, she turned 1,000 into 50 in 10 months. See, she's smiling there. So, you know, some of the other ways in there, you can do subject twos, you can do wholesale direct, you know, and I've got a couple examples, but we covered what we could today. You can do some assignments, over contribute. There's a lot of different strategies that can be used for that.
Hey, Carl, can we take, before you keep going, I just got a bunch of questions. I just want to kind of hit a few real quick, if you
Sure.
don't mind.
Yep.
So Karen's asking, in the case of a rental property, what happens if it loses money? Say the tenant stopped paying and you have it in your IRA.
Well, basically your IRA is going to evict them and start renting it again. And the IRA will pay for that eviction. So you do want to have, you know, you do want to have some money in there. But if you have another IRA, you can either fund it with that. And if you need money, you can go borrow money. Your IRA can borrow money from a bank. It has to be a non-recourse loan. So there's several avenues to do that. But the main thing is you don't want to lose money on rental properties.
Yeah,
And
absolutely.
if you're part of BRIA, you're going to teach them how not to do that, right?
Absolutely. You bet. So Samira is asking, if you already own a rental property, can you transfer it into an IRA if the IRA has money to buy it?
The answer is no, you can't. That's called self-dealing. It's one of the prohibited transactions. You could possibly ask the IRS if they would allow you to get an exemption, but that costs money and time, and they haven't really done that for many people that I know of. They'll let you buy it from your IRA sometimes, but I've never seen them, you know, your IRA buying it from you.
Yeah, what I would just tell you is buy another rental and you're
Yep.
self-directed. So if you already have that in your IRA, move it to Camel Plan so it's self-directed and ready, you know, when you find that deal. So that way you start building wealth in your portfolio with your self-directed IRA.
Yeah, and just another thing, we're different than all the other companies out there. You know, we want people to set up their IRAs. We don't charge them when they're sitting in cash, no annual fees, nothing, because we want it ready. So when an opportunity comes, and you know how fast they come and go if they're good deals in this, you're set up and you're ready to go.
Yeah, there's nothing more frustrating, and I've seen it through members. Oh, I finally found a deal. I'm ready to do this. You know, so if you're rolling over money from another company, like the turnaround's usually like 2 or 3 weeks,
Yep.
give or take.
Yeah, we don't have any control over how long it takes Vanguard or Schwab to get your money to us. But at least get some money in there so you can put a down payment down and get the ball rolling. It doesn't have to be a lot, you know. Most closings take 2 or 3 weeks, but it's just one less thing you don't have to worry about.
Absolutely. So Eric's got a long question, so I'm going to try to read this out. So something to consider is if you're paying taxes up front, then you're unable to invest the taxed amount. So it works out the same. It's just that with a Roth IRA, you technically put in more money than what you see in your Roth IRA account due to the taxes paid outside of the account.
Yeah.
Algebraically, yep.
Yeah.
Yeah, it works out the same, he's saying. However, in a traditional IRA, if you incur a loss you haven't taxed yet, which means it reduces your taxable amount, whereas with a Roth IRA, you already taxed it and hence did not account for those losses.
He's 100% right, but I'm not in this business to lose money.
Yeah.
I don't like tax write-offs when I lose money. If you're going to lose money, I would say don't do this. Don't invest in real estate. I've never lost any money on I shouldn't say never. I lost on one deal, and I've done hundreds of them. You know, you need a better system if you're losing money, and you know, I don't want the write-offs by losing money. Some people do that, but I don't do it.
Yeah, you know what's funny is like I don't mind paying the taxes on if whatever I have to pay, I'll pay.
Yeah.
I'm not looking for, deductions that it's gonna hurt my bottom line. Is
Yeah.
what is the way I look at it too. So I'm right there with you. How do I open a self-directed Roth IRA for my 16-year-old son? Will it be a custodial type of account? So is
It
there an
would-
age limit on to
Yes,
open up a Roth?
yeah, I mean, obviously you would open one up, you would be the person that owns it until he's 18 of legal age. He would obviously have to have earned income, a W-2 or 1099. A lot of parents can pay their kids and then file a tax return for that as well. But yeah, he should make, I think he can make up to $12,000 right now.
That's 12,000. Yeah.
And not pay any tax on it. So he easily makes the $6,000 contribution limit
Yeah. So
for that. So just open it up, put it in. And it's a
yeah. So one of the things that we
custodial
do is we've had Jose Ramirez from Advanced Tax Advisors. So as a real estate investor, Carl's exactly right. If you pay your child less than 12,000, he doesn't have to file tax returns. I should first of all start. I'm not an accountant. Give you my disclaimer. Talk to your accountant. But you could take that $12,000 deduction and then open up with earned income an IRA. That's probably the easiest way. But yes, so it doesn't have, as long as there's earned income, you can open up. Let's see. Can you purchase non-investment property with a self-directed IRA, primary residence?
No, you cannot. Has to be investment property.
Let's see. Eldon saying I'm very interested in what Carl is saying. Can Camel Plan help roll over my annuity into a Roth IRA?
It depends. Is it an IRA annuity?
Yeah, I didn't say.
On those specifics, give us a call,
Yeah.
and that way we don't have to spread it out and record it and send it all over the country.
Yep, exactly. Alberto's asking, what's the tax percentage for a rollover from an old 401k to a Roth?
It depends on what your tax bracket is in the year you do the rollover. You can roll over, we're getting more towards the end of the year now. You can roll over half of it in 2021 and then half of it in January of 2022 if you want to spread that out. But the best thing to do is talk to your accountant.
And I'm just going to add to that. Like my dad, so he's been retired. He's 82 years old. He had a traditional IRA. In the last 5 years, I opened up a Roth, and for over 5 years, I've been moving it slowly so that he doesn't get a tax bill on it. And we've literally saved hundreds of thousands of dollars because it's past the 5-year plan. So definitely talk to your accountant because there will be a tax liability of one point. And maybe, I know someone else was talking about deductions. Maybe you could, kind of wipe it out with, if you have some losses on other stuff to kind of save in the taxes. But that's something you definitely want to work with your accountant.
Yeah, there were a lot of realtors back in 2009 and 10 that rolled over their complete accounts because they, basically had negative income in those bad real estate years. So they rolled it over without any tax liability at all. Not that we wish to have those type of economies, but look for situations in your own world. Talk to your accountant. There are some oil and gas things that will give you tax credits, investments. So look for those types of situations.
Yep. Giselle's asking, just for verification, you can only invest in real estate in a self-directed IRA, not a regular IRA account.
Well, no, you could, but you won't find, Schwab, Fidelity, and Vanguard unless you have 60 or 70 million with them. They won't entertain giving you one of these truly self-directed IRAs. And the reason I know that is there's people that did have a lot of money with them, but they kept moving up the, how much money you had to have with them, and then they would roll them over to us because Vanguard or Schwab were kicking them out.
Yeah. And can I roll over my pension plan to a Roth IRA?
It depends on the pension plan. There's so many different rules and regulations. But the real question is ask your pension plan administrator if that's a capability, and they'll be able to tell you directly.
Yep. And those, and again, like, Camel Plan can help you out with this if you're actually doing your own pension. I know some real estate investors have set it up with a C Corp, created their own pension. Those are definitely a little bit more advanced things that you could do, but Camel Plan and, Carl's team could actually walk you through it and keep you compliant. I think that's always important. Okay, so that's all the questions I got going on now. I'll let you go back to what you're talking about here.
Cool. We'll kind of wrap up here, and I want you to tell you what's going on right now, and I want you to think about this. Right, Peter Thiel took, the news is putting out there. He took $2,000 and he turned it into $5 billion, and they're making him look like the bad guy. And my question, Mitt Romney, when he ran for president, had $100 million IRA. And I think they're examples. I don't think that they should be punished or be considered bad guys. They took the tax rules, they thought about it, and they made the investments and they took the risks. So when I look at that, and by the way, when I first got into self-direction, I was following somebody else that had that and did it and showed me. I borrowed money from him after my dad died because we had a note that had gone into default and was at 28%. So I borrowed money, and lo and behold, it was from an IRA, and I learned about it, and that's how I got into it. So like I said before, I don't want to be the trailblazer. I like going on the path that the trailblazer cuts. So I look at these people as examples that I would like to follow. Now, they're probably a little bit more risky. I was a rocket scientist. I graduated in engineering, so I'm pretty risk averse. But if I maybe had been more risky, I could even have more in my IRAs and 401ks. So I don't really like the fact that people are using them as bad examples. I think they should be put up as good examples, because the government gave us these IRAs and Roth IRAs so that we could save for our own retirement and not be a tax and burden on Social Security and Medicare. So let's talk about the education that the universities and the school systems are giving us, right? They're not teaching you to be wealthy, right? They're teaching you how to get a job, if you really think about it. That's the goal for them is, hey, get out, go to work for the man, get your house, your spouse, and your white picket fence. So you kind of have to educate yourself on these type of things, and you got to put yourself in areas where you can see the Peter Thiels, the Mitt Romneys, and the the couple dozen other people that they're touting out there. And some of that depends on you yourself, because you spend more time planning vacations than you do planning how to build your wealth or build legacy wealth. And it's probably not the people that are on this webinar, because you're spending the time here to learn these types of things, right? And like we talked before, don't spend your time looking for different jobs and raises. Spend more time looking on the investing, because that's where you're going to make your money. That's where they're going to take the least amount of taxes from you on. Social Security and Medicare, right? That's kind of why they said this was going to be the savior of those programs, because there's less and less people contributing to them. And in 1998, they came up with the Roth IRA. Did somebody made that thing a little bit bigger? There we go. Came up with the Roth IRA, and they said, get the taxes now, and spread the bill out later, and maybe we'll get spending under control. So that was one of the rationale for doing the Roth. We'll offer them the capability of doing that. And you know, the Roth name comes after a senator from Delaware. Right. And when you first started out, only couples that made under 150,000 and individuals that made under 100,000 could have Roth IRAs. It wasn't until 2010 that they opened up Roth IRAs or backdoor Roth IRAs for the wealthy. And now they're going to try to close those again, and the wealthy will still figure out ways to get money into them because now they've really seen how well they work, right? Most of the people probably aren't on Social Security or Medicare, but let me just tell you a little bit about what I found out is I've been working for 50 years. My wife and I are getting like $3,900 a month on Social Security. Out of that $3,900, we have to pay $1,450 to Medicare every month. So we get to keep about $2,500 a month to spend between us. And I can't, you know, that's 30,000 a year, and my living expenses really aren't there. So I feel bad for people that haven't done this, haven't saved, and gone that way. So let's talk about if you don't do anything, you're going to end up on the government plan, which is basically what I just told you. If I didn't have anything else that was there, or you'd continue to work and still get that. So you have to decide if you're going to use your plan and sit down and make that plan, or take the government plan. I suggest you look at it and make a conscious decision of where you're going to spend that time and energy doing it, right? And now with all these new rules that Congress is trying to take it away, who's it really hurting? Is it going to hurt Peter Thiel? I don't think so. He's already made his money. Is it going to hurt me? No. I mean, I'm all, you know, I've got, you know, I'm up there in age. It's not going to hurt me at this point. It's going to hurt the younger people that I'm talking to that aren't going to have these capabilities to really grow their IRAs and 401ks. I hate when the government limits what you want to invest in. For years, they've been trying to get people to invest in government bonds and treasuries, which are 1 or 2%. That 1 or 2% isn't going to mean anything to people. It's not going to change your lifestyle one iota as you get older. You have to be looking for investments, you know, plus 10% and hopefully 15 or 15% or above to really make a difference in your lifestyle. And I'm sure BRIA and the other real estate investment associations around the country can help you with ways to do that in the future. So, you know, not to get too political with it, but, you know, basically the SEC is talking about investments, private placements, things that are too risky for investors, you know, that don't have special education or don't make X amount of money, you know, which is $250,000 a year or more. Then you're not allowed to invest in these assets. Now what they're trying to do is say the wealthy can't invest their tax advantage plans in these types of assets. So instead of the SEC changing the rules and letting everybody invest in these assets, they're trying to force the wealthy not to use their IRAs and 401ks to invest in these assets, but to limit them to only using their outside cash, so that when they make these big returns, they pay taxes on it. I don't know where that's going to go, but from a lot of the wealthy that I've talked to, they'll just find other investments for the money that are more tax beneficial than those are. And I don't know what it's going to do to the small businesses and the rental part of it. But I want everybody on here to kind of think about that. I think taking choice away from the people is not a good thing. I think people can take the time and educate themselves. Don't invest in anything you don't know and understand, but don't limit other people from learning and being able to invest in whatever they want to do. So either way you feel, contact your reps and senators and tell them what you think about the new bill. That they're playing out as tax the rich, but they're taking away choice from everyone at this point in time.
Yeah, I was just going to add that, obviously there's going to be, we'll have a webinar probably at the beginning of the year with Jose. As we start seeing some of these new tax things that may happen, if you guys have been hiding out, they are proposing income tax, ordinary income for those prices to go up or tax rates to go up. We haven't even talked about it. I could probably literally do like an 8-hour webinar with Carl, which is kind of funny. We haven't even talked about inflation, right? You're talking about your 1 or 2%. Well, you're actually losing money on buying power with inflation, what's happening. I mean, you're starting to see prices, on goods, whether it's food, gas, all go up. I know some of the other questions I get, and as Carl puts up his information on there, you can always call our office too, to get Carl's information. Also, one of the questions I always get is about asset protection. So if I buy, is my Roth or any of my self-directed IRAs, can I lose? I know that's kind of a not complicated, but I know there's some things that may or may not on it. Can I lose my money if I get some judgment or something? I got into a car accident and they try to.
That's a great question. And you got to say, is it in or out of the IRA? So if you get in a car accident, the answer is right, and you're at fault. The answer is no. Right now, the government won't allow them to take your 401k or your IRAs in most states. So if you're at fault in an accident, your IRAs and 401ks are safe. That's one of the reasons I tell people not to have. I would rather have a Roth account than a savings account at a bank, because if you do get in an accident, they can take your savings account. They can't take your Roth. If you think about O.J. Simpson, right? He got a big judgment against him, but they couldn't take his 401k from the NFL. Now, that's not to say that if you had a house, if you bought a piece of real estate in a house and you had a fire and somebody got burned, could they sue the IRA? Yes, they could, but just like any other piece of property that you'd own, you'd have insurance that would hopefully cover that. But if it doesn't cover it and they awarded a big judgment, then you definitely could lose the house. Now, one of the ways around that several attorneys have advised clients is to open up a separate Roth or separate IRA account for each piece of property that you own. That way it's like a separate entity, and it's not, if you lose the one property, you're not going to lose the other properties. So you'll have one account number, 1, 2, 3, 4, 5, and the other will be 6, 7, 8, 9. And each will hold just one house in it.
Yeah,
and
I'm just gonna, one thing before I forget is you just touched on something really important. So if you're new or you have limited income, right, and you maybe you have $1,000 or $2,000 saved, you heard Carl talk about it. So you're better off opening up a Roth IRA, and you could actually get back your money without a penalty on the money you contributed on a Roth. So let's say I had $2,000 in my savings account. You're better off opening up an account with Camel Plan, put the $2,000 in there. God forbid, you need the money, right? Something happened. And, basically you just fill out some paperwork. You probably get your money back. I'd say 3 or 4, maybe a week max. I don't know what your turnaround time is on if they need the money versus it being open up for judgments, lawsuits, all the above.
Yeah, no, I mean, and that's with any IRA company out there, not just Camaplan. Anish, I mean,
Correct.
that same rule is there. That money's already been taxed. They'll let you take it out. They'll let you take out any of your contributions at any time. So that is a cheap asset protection way of doing it. Put, 6,000 or 6,500, whatever you 7,000, whatever you can put in every year, and use that as your savings account or rainy day account, even if you leave it in cash.
Yeah, totally makes sense. And again, this is all about wealth building. I know everyone wants to make money fast. I get it. But once you start doing it, as I said, like I was pretty like psyched to see my Roth start really blowing up. And as I'm doing deals and before I wasn't that interested, and now I'm like consumed by it. And also the other thing I always hear is like, hey, I don't have money for deals, right? So if you learn how to do self-directed IRAs and you're a real estate investor and you don't have any money, and this is the best thing out there, right? And when people ask me, hey, if this is such a good thing, Anish, do you have a self-directed IRA? I think it would be very odd for me to say, yeah, it's a really good thing for you, Carl, not for me, right? So I know, that's how you really start raising money. If you're really good at what you do, they're not doing appraisals, they're not checking your income limits, they're not checking your credit, maybe, depending on, they're really looking at the deal. So it's a quicker way to get money for your own personal deals, if that makes sense, versus the hard money or traditional lenders out there. So.
Sure. No, what you say makes a lot of sense. We have people that are good, and people come up to them and say, "Hey, is there any way I can work with you?" Especially, people that are mentors, and a lot of mentors will say, "Yeah, I charge this amount. I'll mentor you, or you can lend me money out of your IRA or some other place, and charge me this interest, and I'll let you see everything I'm doing." So that way, both people win on it. You're getting paid
Absolutely.
instead of paying for it. So there's a lot of different avenues that are out there. And again, we only had an hour and a half today, but that's why I think it's important for people to go to these events, the things that Alexis covered in the beginning. I don't think it's as good as being there and talking to the people and seeing their jobs. And I mean, even if you have lunch with a couple of these people, once a week, go to lunch with somebody different, find out what they do, look at their operation. Most people in these real estate clubs are eager to share information. They know that there's enough to go around.
Absolutely. I think I know we're out of time today. So first of all, I want to thank you, Carl. I was just thinking off the top of my head, I know this is like a pretty introductory thing about self-directed IRAs, and maybe we'll have you come back and a couple of months, maybe we'll do some more advanced, maybe we'll show some of the deals that like we're talking about joint ventures, if they're doing PPMs, are they doing a lot, are they buying it in a trust? And there's some real, like, we're just kind of like peeling the onion a little bit. Like, it's just like, okay. And once you start, getting into this, you'll start seeing some higher level stuff of what you can really, really get this thing, your retirement stuff really on steroids is what I would say. But, so.
Yeah, for sure. I mean, you got to walk before you run, and we do have a presentation, for people, but basically anybody that goes to those presentations already have to have a self-directed IRA. They've already have to do, at least 2 deals in it, and have a basic understanding of what's there, and then they can take the next step, 202.
Yeah, and I just want to commend people. I did put up that poll. Over 80% of you have a self-directed, or I would say a retirement account, I should say. So that's 8 out of 10 of you. Good job, right? Number one. The 20% that do not, what are you waiting for? Again, Carl, what's the minimum they could open up an account with you guys? Do you have, I know there's a minimum.
Well, I
you
mean,
guys, your
yeah,
clients.
some of the HSAs are, they can only put in 3,200. So we have a couple people like that. We have some kids that are less, but basically we want everybody to have at least $4,000 to open one up. But if you're going to have less than that, and you've got, somebody like a mentor out of your club that can show them how to, architect a deal and build that, then it's worth it. But I don't want to, I think we charge like $50 a month for any account, a year for any account under $4,000.
Yeah, yeah. I mean,
just,
again,
just
Carl,
because it's reporting things.
yeah, Carl's not, on his mega yacht on it, those $50 fees. So I know.
Yeah. Well, yeah, just to put 4,000 there, if you're not going to work it, if you don't have the capability to work it, then it's just sitting there as lazy money. And I don't think that's good for anybody, right? It's not going to, they're not going to recommend us to anybody because they had 4,000 sitting there. So it's just,
Right.
a lot of our stuff is by word of mouth and people trusting us, et cetera. So I want, if you're going to be with us, I want you making money.
Yeah, you want, like, again, it's a good point. Like, just to put it there and do nothing, inaction is going to cost you more money. It's a no-win situation. But we gave you that example of that low balance and how you could actually grow it. So
right.
Again, a lot of great strategies out there. Carl Fisher is definitely one of my favorite people. I'm always excited. I'm happy to hear about some of the things that, the new laws that are coming up, and, giving us an insight of how the world's changing a little bit on the retirement end of it. And the more importantly, like, Carl's an investor himself. So he's not a guy that's, just saying, hey, you should do this. He's using these techniques. I was actually on a panel with him one time, and he knows I flip houses. And I remember, I won't use the language you use, but you said you're too lazy to do all the run around, because every month I have to hunt, kill, and eat. And he said, I just rather buy a building instead. So and those are the things that I've learned from Carl. And I'm like, yeah, I got to pick up my game on this stuff. So we are blessed to have you here in South Florida, number one, since he pretty much moved down here most of the year, I guess now, right? You're living here half the year.
Pretty much, yeah. Yeah.
So
it beats Philadelphia.
Absolutely. So again, Carl, any last words that you want to tell our viewers?
No, I just hope that they'll take a little bit of time, talk to our people, see if it makes sense, take little steps, at least open up an account, put some money in it. It'll remind you, right? If it's over 4,000, we don't charge you anything a month, but it'll remind you to start using this and invest, because we're changing a paradigm from everybody teaching you to get a job to teaching you how to be wealthy and using the tools that are available to you to help you get there. And if you don't want to do it, that's fine too.
Exactly, right. So again, thank you guys. We have some upcoming events. All our replays will be on our YouTube channel. Give us a few days on there. I know there are a lot of specific questions on what you may or may not have, or what you can and cannot do. The best thing is to call Camel Plan. The number is right on the screen, 866-559-4430. Their team is beyond experience. As you could tell, Carl's been around in the business for a long time. There's probably not much that you haven't seen. I'd be surprised if there's a scenario that you don't know. But they do have access to enough people that I know they'd get you the right answer. Yeah. So
cryptocurrency is one of the ones I'm a little waning on. I'm not very good in that area, but yeah, pretty much everything else I've seen. Go to our website, camelplan.com. There's a lot of videos on there. There's a lot of learning. There's a lot of reading that you can do to help you get better acquainted with this. But we'll be glad to help anybody that has any questions. And again, share what you learned today with your financial advisors and your accountants, and just listen to what they have to say. Go with them or not, that's your choice. But I would at least experiment with this like I did the first time I heard about it. And
yeah.
It has
and I know some
made a difference in my life.
And I know some of you guys have your trusted financial people. I know that, put them on the call too. Just do a conference call with the Camel Plan team, So you could actually pick out a strategy that works for you too. So thank you, Carl. Happy Wednesday. Thanks for spending some time with us. Yeah, I'm gonna have to come see you on the boat. So pretty soon and, pick your mind, obviously. So thank you, Carl Fisher, our team. Our next event is coming up soon, which is our boot camp this weekend. And we have a couple more events coming up in the following weeks. So everyone have a good day and we'll
Yes,
catch you
look
soon.
out for a thank you email where you're going to get that ebook 20 ways to fund a deal. It'll be coming to you shortly. And I'm going to put in the chat the links to our upcoming events.
Thank you guys very much for having me. I really appreciate it.
Thanks, Carl. Take
Thank you,
care.
Carl. Bye.